Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management with your weekly market and economic update for the week of October the 19th, 2020. As always, please make sure you read the disclosures that were attached to the email that sent this video out. Or if you're watching this on social media, just simply go to lplresearch.com, read any of the disclosures that you might find therein. So in this commentary, we're going to discuss politics and investing. What I'm about to tell you might really surprise you, but the fact of the matter is when it comes to elections and the market, the winning party has very little to do with whether the markets go up or whether the markets go down. We get this question with every single election cycle, and maybe we could agree this election has more urgency. We're fielding questions about the differences in policy and how that could affect the markets and the economy, or if the market is suddenly going to tank if one candidate is elected over the other. The answer that solves all of this is don't get wrapped around the political axle and invest based solely on politics. At Fross and Fross Wealth Management, we continue to believe that while politics do matter, they shouldn't be the sole thing used to direct our investing. What I thought I would do today is to maybe debunk some popular political myths. So let's dig in. Number one, is there anything that we can learn from the years of a political cycle, the first, second, third, and fourth year? And the answer is yes. The stock market has ebbed and flowed with the election cycle for the last 182 years. Since 1833, the Dow Jones Industrial Average has gained an average of 10.4% in the year prior to the election year, which had been last year. When we look at the election year, the stock market's averaged 6%. But an interesting trend develops when we look at the first 2 years, which would be next year and 2022. And that is that in the year after the election, the market only gains 2.5% on average, and the second year averages 4.2%. However, there are some notable exceptions to the rule. You could throw in 2008 or 2000. But the fact is there is a trend. And so far, we haven't even talked about which party, right? This is just the years of a presidential, the presidential cycle. Number two, the one you've been waiting for, Democrat or Republican? Now, you might feel strongly about one party over the other when it comes to your politics, but when it comes to your portfolio, it doesn't matter much whether one party wins or the other party. Most people, interestingly, feel that Republicans are better for the markets because they're thought of as more business friendly, lower regulation, lower taxes. However, if we look all the way back to 1900, we see that Democrats have been slightly better for the stock market, with an average annual return of 9% when Democrats control the White House, compared to only 6% per year under Republican leadership. Now, there are always exceptions to the rule, and there's other mitigating factors. For example, President Obama took the White House in January of 2009, and during his 8 years, we had phenomenal economic growth. And then you could go back to George H.W., who inherited the White House in early 2001, and we were in the midst of the dot-com bubble burst. So the fact is that's only one of the factors that we look at. Let's look at the next one. If the person in the White House doesn't have much of an influence on the stock market, then can the stock market have a big influence on who is elected? And the answer is yes, it does. If the stock market's up in the 3 months prior to the election, then the incumbent party usually wins. If the markets are down in those 3 months, then we have historically seen a new party in power. In fact, in the 22 presidential elections since 1928, 14 of them were preceded by gains in the 3 months prior to the election. And in 12 of those 14 instances, as you would guess it, the incumbent party won. In the 8 elections preceded by 3 months of stock market losses, then 7 out of 8 of those, the incumbent lost. This adds up to an 86.4% success rate for the S&P 500, accurately predicting the results of a presidential election. And we look at this year, Over the last 3 months, the market, the S&P 500 is up nearly 9%. So the fact remains there's positive and negatives in every candidate with every political party when it comes to elections. In this election cycle, it's hard to find even one undecided voter. We all seem to have very strong opinions about what should happen for our country. However, in divisive times like these, we continually come back to the phrase, how do we know that it's good, or how do we know that it's bad? No matter who you have or will vote for in this election, things are never as black and white as what the media would lead us to think. Each candidate has positives and ultimately negatives. And President Trump has shown us his positive attributes over the last 4 years, and many negative ones. And Biden, remember, Biden has some positives too. Under Biden, we're likely to see a resolution with our trade war with China, less tariffs. That would be good for corporate earnings. We likely would see lots of money being spent on infrastructure, which could ultimately be good for our economy. We likely would see improved relations with Europe, one of our largest trading partners, if Biden were to win, which would increase corporate earnings in S&P 500 companies. These 3 points alone tackle 3 of the 20 different economic indicators that we look at for the direction of our economy and ultimately the market. We also hear concerns about the market tanking in November if Biden were to win. Again, we simply do not believe this. Remember, even if Joe Biden does win the election, he doesn't take the White House November 4th. We've got until January of 2021 before Inauguration Day, and a lot can happen between now and then. And once he is president, he'll have to then nominate his cabinet members and then wait to have those approved. He'll then have to work on his economic plan and get that pushed through Congress. And that's a long process. In other words, changes to policy are generally slow and gentle. They're not drastic and immediate. We have no reason to believe that this won't happen this time in case there is a party change when it comes to the White House. The markets and the economy also, they just don't pause before an election. They keep on going. The state of the economy is a lot more important to us here than who wins the White House. It's easy to get lost in the rhetoric and the predictions when we're in the thick of the election cycle. However, the economy is doing its thing no matter what's being said. To that end, there are 3 positive things happening in the economy, in addition to what we've already talked about. For instance, manufacturing is on the rise. Manufacturing jobs are coming back to the United States, and we see this driving employment growth, productivity, and corporate earnings. Technology should continue to drive growth as companies across industries digitize to avoid becoming obsolete. This is important because digital economy comprises 9% of GDP, and that should affect corporate earnings positively. Also, globally, we're seeing upward growth as well. One of the economic indicators that we look at is the Purchasing Managers Index, or PMI. The global PMI report for September showed 14 of the 18 regions globally that are being monitored either strengthening or expanding. If we are in the early stages of an expansion, and the monthly numbers indicate that this is the case, typical economic expansion lasts on average 8 years. Global PMIs are highly correlated to corporate profits, which support the positives that we've already talked about. So overall, things are not half bad. That being said, we are expecting a lot of volatility up until Election Day and possibly shortly thereafter if the election results are contested. And so our suggestion to you would be strap your seatbelt on, because volatility is probably here to stay. Elections, they have consequences, but these long-term trends are embedded in the economy and should continue to emerge despite where the political winds blow. We strongly hope that this has helped shed some light on the reality of things to come and put you more at ease about the election. We are here to answer any questions or go more into depth if you need us. You might have noticed that we are having some upcoming seminars, public seminars. And in these seminars are generally, or I should say, fairly general in nature. So if you're wondering how the upcoming election might affect you personally and your own portfolio, feel free to give us a call here at the office. 352-205-7800. We'll be more than happy to meet with you. Have a wonderful day. We look forward to seeing all of you soon.